What's up everyone, it's Caddy with MoneyVest. So we've got lots to unpack in this video. I'm going to be breaking down what happens during election years with respect to the S&P 500. So we're going to be focusing our sort of analysis a little bit more towards the second half of this year of 2024 because we've got a very big event in November. Not only do we have the FOMC meeting, so 4 more FOMC meetings left with 2 more coming out with the summary of economic projections. So again, monetary policy is going to be front and center with regards to inflation and interest rates, but we also have a huge political angle to this entire situation, especially when things have taken a huge turn since yesterday, of course, after the attempted assassination of Donald Trump. And I'm going to discuss a little bit more about that as well. But mostly, we're going to be focusing on how election years have essentially played a big role in the market's performance. So again, our main focus is going to be the S&P 500's performance during election years. I'm not going to get political here in this video. I'm not going to share my political views, as I'm sure there's going to be a lot of back and forth. We can debate all day long. So this is mostly going to be focusing on the markets aspect of this entire situation. So hope you all enjoyed this video and find it helpful. Please make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. And again, links to our Discord and Patreon is going to be down below if you're interested in joining us. We've got a 51% discount right now that we're offering until the end of this month. And you can access the entire MoneyVest platform, including a lot of members-only private videos, the trade alerts and trade ideas. Everything's going to be included, as well as our Discord channel. And there's going to be a lot of future updates and functionality and features that you can access at no additional cost. You can lock this price in for a life until, of course, you cancel. So link's going to be down below, and you can access and do a full comprehensive fundamental analysis on a lot of individual stocks, over 17,500. And eventually, we're going to be adding ETFs, our MoneyVest index, S&P 500's fundamental and technical positioning, portfolio analytics. Everything is going to be a future update for all of you. So link's going to be down below if you want to join. And again, 51% discount expires at the end of this month. So this probably is the hardest picture that's been trending on Twitter, YouTube, everywhere that you look at. This is probably one of the coldest picture when it comes to politics over in the US. Elon Musk posted this, as we already know what's taken place. And even Tim Cook essentially, and this is what Elon Musk also said, I fully endorse President Trump and hope for his rapid recovery. And Tim Cook also tweeted saying that I pray for President Trump's rapid recovery. My thoughts are with him, the other victims, and the Trump family. I strongly condemn this violence. And President Biden also tweeted, I have been briefed on the shooting at Donald Trump's rally in Pennsylvania. I'm grateful to hear that he's safe and doing well. I'm praying for him and his family and for all those who were at the rally as we await further information. Jill and I are grateful to the Secret Service for getting him to safety. There is no place for this kind of violence in America. We must unite as one nation to condemn it. I think that's really important here, to make sure that everybody is safe and sound and there is no violence that's taking place in this political race, because as we know, it's going to get dirty, it's going to get nasty. That's what politics is all about. As we've seen during the debates, there's shots taken, not literally, although last night quite literally, but in general during debates, shots are fired, and there's a lot of sort of back and forth during debates. But at the end of the day, it's really important that we have to understand that everyone is simply a human being. And I think the respect for human lives is the main idea. It's the main kind of the core foundation for any type of debate or any type of political rally here. So I think this is something that needs to be stopped and cannot be tolerated at all. So again, it's really important. But as many people have already mentioned, or you might be seeing that on Twitter or YouTube or whatever, it is likely that this kind of pushes the scales significantly more in favor of Donald Trump at this election that's happening in November. And as we know, during Donald Trump's reign of 2016 all the way to 2020, of course, the markets rallied almost 90%, so they almost doubled in value in those 4 years. But of course, President Biden has also seen an increase in the stock market of close to 70%. This right here is a very good chart of the different presidents of the U.S., and again, from Nixon to Carter to Ronald Reagan to George Bush, we got Clinton, Obama, we got Trump and Biden. All these presidents have, of course, seen the markets significantly increase, except for George W. Bush, that has seen the markets collapse during his reign. Of course, that was back in 2000s. And then even, I believe, Ford or Nixon has also seen, again, twice in the 60s and 1970s, both times he's seen the markets come down. But other than that, overall, the markets have done really well as they have pushed higher and higher since 1960s all the way to where we are now. Again, the market's near all-time highs. Now, this right here is the most important chart that I want to break down. And this is S&P 500's performance since 1950s. And this is during election years, during non-election years, and during all years. And all years, you'll notice the average return since 1950s is 8.86%. So that's the average return since 1950s, with a max return of 45%, a minimum return of 38%. So that's probably one of the declines we've witnessed. Then we've got volatility of 16% plus or minus, and positive years have been 72%. Non-election years, the average return has been a little bit higher at over 9.2%. However, the probability for a positive year is significantly lower than for a year when there is national elections, presidential elections. Because if you take a look at election year performance, yes, the return is low at 7.26%, but the probability for a positive year is over 83%. So the probability for the markets to be green during an election year is very, very high. And the markets are obviously doing really well. They're up 15, 16, 17%. If you come over to the S&P 500, year to date, we've seen the markets go up about 18% right now. So again, the probability for us to close out the entire year in green, in positive, is incredibly high. 83% during election years since 1950s. And this right here is an even better chart, goes into more detail in terms of seasonality broken down by months. And this is price performance for the S&P 500 for all years since 1950s. And this is price performance for S&P 500 during election years since 1950s. And what you'll notice is that positive months, right? So percentage of times that particular month is positive is more when it comes to election years. So again, you'll notice that going into the months that we're going into now, which is August, September, October, November, December. So 5 more months left. We're kind of in third quarter already. So if you notice August over here versus August here, got 61% probability that we're going to see a gain in the month of August because it's an election year, versus on all years, we've seen a probability of 54%. 50% probability that September is going to be a positive year versus 43% in all years. So all years probability is low for a positive September. September is usually the worst month for the market, but during election years, it's actually a coin toss. It's 50-50. October is low, 50%. Kind of leading up to the election, which is elections in November. So 50%, again, it's a bit of a coin toss during election years. October is 50-50 versus non-election or all years combined. We're looking at almost 60%. But here's the catch. As the markets are a bit of a coin toss going into elections, what happens after elections is what's really interesting. A full 10 percentage points higher, which is the 83.3%, as mentioned earlier, in the month of December. So the close to the entire year is incredibly strong for the market, with an 83% probability the markets are going to be green versus all years at 73%. And again, if you take a look at the average gain, all years a little bit higher, 1.43 versus election years at 1.35, but nonetheless, the probability for a positive close in December is significantly more, 10 percentage points more than all years. So August, September, October, November, December, all of them are 50% or more in terms of probabilities of it being green moving forward. So we are kind of shaping up, or we've kind of positioned ourselves in the next half or the second half of 2024 to be very strong in terms of gains. Not only because of how the markets have done in the first half and there's momentum carrying forward, but also because of the fact that it's an election year, and election years are usually, not always, but most of the times are bullish with a very high probability of success to close out the entire year. So this right here is the earnings coming up in the upcoming week. I'm going to be doing videos on a few companies like ASML, Johnson & Johnson. I'll see if I can do videos on those companies. Again, we can come over here. You can use our entire MoneyVest platform to do full comprehensive analysis on all these companies. So if you want to get a good idea of, okay, what's the consensus expectation for ASML's numbers. So again, you can also plot and visualize a lot of these data points, but let's come over to analyst estimates. If you come over to the quarterly numbers, so as you'll notice, that it's loading right now. So the company is going to be reporting again next week. So for the fourth quarter period ending in December 31st, or period ending in March 31st, expectations are an average of about $2.82. So this right here are the earnings that they are going to be reporting. First quarter 2024 is what they'll be reporting for, which is going to be an expected 41-42% decline on a year-over-year basis based on 20 analysts' expectations. So that's going to be the number for ASML. Again, Allies reporting. We do have Bank of America, United Health Group, Progressive, Morgan Stanley, Charles Schwab, PNC, State Street, Goldman Sachs, BlackRock. A lot of banks are going to continue to report here. And then, of course, we've got one of the FANG stocks, Netflix. We got TSMC, United Health. We got Domino's Pizza. And that's pretty much going to wrap up the entire earnings week here. We also have American Express reporting next week. Halliburton, one of the defense contractors in the world. Infosys also reporting. KeyBank also reporting. Abbott is also going to be reporting on Thursday before the markets open. So lots of earnings coming up. And this right here is going to be the economics calendar. Fed Chairman Jerome Powell is talking again on Monday, July 15th. We got FOMC member Mary Daly also talking. We got core retail sales, actual retail sales, month over month, year over year coming out. Atlanta Fed GDP numbers are going to be scheduled for the second quarter at 12 p.m. Eastern on Tuesday, July 16th. And then we also have building permits, housing permits, again, industrial production. We got the beige book, we got the 20-year bond auction, and we got the 10-year tips auction. Fed's balance sheet, a few more Fed members talking, and of course, crude oil numbers and reports also coming out. Now, this right here is from Strat, from Tom Lee, of course, and he's expecting the S&P 500 to more than triple by the year 2030. And here are some of the reasons why. And I think I do strongly believe that over the next 6 to 8 years, I think we're going to witness a very, very strong market from an S&P 500 standpoint, which is exactly why it's going to be so much more important for us to keep a close eye on the MoneyVest index, because the lower it gets down to, the better the opportunities are. I mean, I cannot put enough emphasis on how valuable this information has been for myself in my own trading and my own investing, because every time you kind of try to pinpoint exactly when this index is going to give us a buying opportunity, it's worked out really well. Because the last time I can tell you the buying opportunity was back on April 20th, right around here. Take a look, the markets were over here. Go back a little bit further, October of 2023, the markets were all the way down here. You can go back even further. And again, the list goes on and on, because if I, again, mark some of those times when the markets have given us opportunities, you come back to, let's say, March of 2023. March of 2023 was over here before we went on for a very nice rally over here. If you come back prior to that, this is March of 2023, as I already mentioned. Come back even further. This is September and October of 22. Which was quite literally the bottom for the market, September and October of 22. Again, if you come back, it's crazy. You'll start to see it. This right here is June of 2022. This is June of 2022. You'll notice a very nice rally after. Come back a little bit further. This is May of 2022. Let's see where we were back in May. This is May of 2022. Again, a little bit of a dip, and then we saw a nice rally. Come back a little bit further. This was March of 2022. This is March of 2022. If you come back a little bit further, this is December of 2021. This right here is January, and this right here is December of 2021. So very similar pattern, because this was also making some lower highs and lower lows. By the way, I missed this one. This is January of 2022, and this right here is January of 2022. So again, perfect buying opportunities. If you come back a little bit further, before the 2022 bear market, we're looking at September 21. This is October and September of 21, before the markets started ripping higher. And prior to that, the markets were relatively more expensive, so we didn't quite dip below 3.5, so we didn't really come down to the green sort of zones. We were only in the yellow zones, which is right over here. So even then, you'll notice a couple opportunities in July 21, in June 21, in March 21, and then January of 21. So all of them were dip buying opportunities. So that right there is July 21, June 21, May 21, we've got March 21, we've got January and February of 21. So all of them were buying opportunities as represented by the MoneyVest index. So it's really a very, very useful tool for myself that I utilize, and I update this value. This gets updated automatically every day. And then we and the community members use it all the time. I share the value of where we are and how well positioned we are from a risk reward standpoint. So again, if you want to get access to these values, I'll share the chart every day. Right now, it's not available on TradingView. We're going to eventually make it available on our platform, so that everybody can actually utilize it. And it's super useful to keep a track of where we are with the MoneyVest index and how well positioned we are from a risk reward standpoint in the S&P 500. But coming back to Tom Lee, so one of the big reasons that he sees the markets rallying is because of the average age of the millennials. We're at 26 and a half years old right now, the millennials and their generation is, and that's kind of the prime age, or we're kind of entering the prime age where people are going to be spending more, borrowing more, investing more. So we're kind of entering the age where we're going to be buying our homes, we're going to be buying cars, we're going to be spending using credit cards, we're going to be working our prime, right? So we're going to be earning a lot of money, and that's what's going to fuel the entire economy and the market. And this has happened 3 times. So he basically says that this would be the 3rd time that stocks entered a cycle where annual returns compound at high teens. You had the roaring 20s, then you had the 50s through the late 60s, and then this is the 3rd cycle. They all coincided with the surge in the number of people aged between 30 and 50. So in other words, the number of prime age adults, and this is the time it's powered by millennials and Gen Zs. The second one is the stock market peaks and demographics. So again, this right here, the stock market has a history of peaking right around the same time a population hits a peak, prime age of around 50 years old. And this doesn't happen for us until the year 2038. So suggesting plenty of upside ahead for stock market between now and 2038. And tech, of course, will address a global labor shortage. So they believe there's going to be a significant labor shortage because of this opportunity in AI. So big opportunity for US technology companies because of AI, which is supplying the global digital labor, because there's a global labor shortage. So these 2 factors forcing a combination to what I think will power them almost a decade of extraordinary good stock returns is what he mentioned. And I think there's going to be a lot of dollars spent on US technology products because of the world is short 80 million workers by the end of this decade. And that is roughly $3 trillion of labor salaries that's turning into silicon. So that means US suppliers of silicon and AI are going to have $3 trillion more of revenue run rate. Essentially, people getting replaced by automation, by AI, and by robotics. Now, this can be a bit of a concern as well, which I'll get to in just a second. So this right here is one of the craziest charts that I actually saw. And this is software development job postings on Indeed in the United States. And what you'll notice is software development, one of the most important skills of development, right? Engineering, programming, writing code, software development in general. It kind of peaked during 2022, as you'll notice that this was the peak for people hiring, companies hiring for software development. And then immediately just a huge crash, right? So this has been a huge significant pullback in number of companies hiring or job openings being posted on Indeed, which again is a kind of a LinkedIn for hiring and firing, for hiring people for your company, and a significant decline. And this is all part of, in my opinion, automation, robotics, the lack of requirements, and a lot of companies being outsourcing their workers to other parts of the world and mostly focusing on contractual work and gig economy because of the lack of benefits and health insurance needed from contractual workers, from freelancers in that sense. So it's a huge cost saving for companies. They can also do, if an experienced developer can now be significantly more efficient because of the help of AI. So you don't really need a lot of man hours. Instead, what you need is really well-programmed AI or machine learning or something that can help you write code and debug and, of course, fix and resolve your downtime. So this, again, can be a good and a bad catalyst in the sense that, in my opinion, I've got it on very strong record that I believe there's going to be higher levels of growth, higher levels of productivity, and also high levels of unemployment. I think that's sort of where we are headed moving forward because with AI, it's going to replace a lot of jobs. It's going to put a lot of people out of work, which again is not the best case scenario. It kind of hurts to say this, but it's the truth. If we don't upgrade our skills, we're going to get left behind. I think that's really the reality of the situation because of artificial intelligence. And money will flow into US tech stocks. So automation technology becomes 50% of the S&P 500. So that's a bold prediction right now. It's about 35%. And technology becoming 50% of the S&P 500 is going to be even high levels of concentration in the S&P 500. So those are the 4 or 5 reasons as to why Tom Lee believes that their S&P 500 could more than triple, to 15,000. And of course, a lot of other factors involved with the markets, with the potential to do really well during times of election and moving forward as well. So let me know your thoughts down in the comment section below, and what do you think and what do you make of this entire sort of analysis. Again, hope you all enjoyed this video, and make sure that you drop a like and subscribe to the channel. Again, 51% discount available for the MoneyVest beta launch. This discount is available until the end of this month. You can access the entire platform, do your full comprehensive fundamental analysis on a lot of individual stocks, and of course be ready for a lot of future updates and tools and functionality that we're going to be adding over time. Our customer support team is super responsive and very, very prompt. So if you have any questions, just simply create a ticket on Discord and we'll get back to you as soon as possible. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.